Yeah.
Yeah, so we have a good episode today. We're going to do a follow up on the it's national real estate market indicators, mortgage market, which is heavily affecting the national real estate market as well. And then we're also going to discuss the local Austin market. We have some particular challenges locally that I think is relevant to everybody nationwide as well. I think everybody's kind of facing similar challenges. So to get started, we put this episode together a little over a month ago because things looked really uncertain. It was the tariffs had taken effect. The Every market reacted negatively to it, and rates were going up. A lot of uncertainty in the air. The stock market was going down. Everybody's 401k. No one's 401k looked great at the time. And since that time, it looks like things have stabilized some, right? I mean, there's still uncertainty because we don't know for sure that things will remain stable, but things have calmed down quite a bit. So with all of that said, what are you guys seeing? Aaron, Max, like just general, before we dig into numbers, what do you guys see? What do you guys feel about everything right now?
It's a lot of, I would say, from a rates perspective, they definitely haven't been moving the way that they should. There's I won't say his name, but there's a well-known mortgage predictor.
Puts a lot of stuff out there back in 2020. 2023 was the day that everything changed. And that was the big thing that everybody was holding their hat on. And a lot of the predictions he made up until that point in 23 and then after were all wrong. And the one thing that he kept saying is, I'm not wrong. The market's just not doing what it's supposed to be doing. Like to me, it lost all credibility. Like he's clearly very intelligent, but he made some predictions. He got them wrong. He got them wrong. It's not that the market didn't do like it just things happen, right? And I think that's what we're seeing now. When we talked last time, uh, it was just after Liberation Day and then tariff turmoil time. So what's been interesting, we had these tariffs on China, then it went to 145%, 180%, whatever it was. Uh, Market's going crazy. Then tariffs pause, but the bond market didn't go down. 10-year kept going up. Um, then we strike a deal, supposedly, and now we have the framework of a deal. It Bond market kept getting worse. 10-year kept getting worse. So like I've been on the record as saying I think there's a path for 599 by the end of June, and like if that doesn't happen, I will be the first to say I was wrong. And I very well could be. Like that may be the case. We're definitely in an upward trend on the 10-year. I'd actually just like to share my screen very briefly. I won't do a very long one, but just right here. So here's kind of what we were. The last time we spoke, we were in this kind of downward trend line. We were coming up, but still up against resistance, and it looked like we'd probably come back down and start testing lower yields, and that didn't happen. We shot straight up. I was encouraged this morning because yesterday we hit right on this line, this Fibonacci line of 4.55. This is a really important level. You can see all the times we couldn't get under it, and then all the times we tried to get above it and couldn't. If we have a close above this level and then a confirmation, it's likely that we'll come back up here and touch this 4.8 level that we hit back in January. So right now, breath's holding, but we had really good, for us, good PPI data this morning, and retail sales came in significantly worse. So I say it's good because bad news is good news for us. So we'll see where this goes. If we can fall back down, test this 4.35 line, and then start coming down and getting some confirmation, so things will start to look a little bit better. I don't know if that's going to happen or not. Rates as of yesterday on Mortgage News Daily were up to 699. Now today they're back down to 694. But there's a lot of uncertainty and what's going to happen, what the administration's going to do. The Fed is saying they're not necessarily going to cut rates next month. It's higher for longer. It's wait and see. The administration's calling for rate cuts, and some of the stuff that they talked about doing, and I mentioned this the last time we talked, where they could swap short-term debt for long-term debt. It's been happening, but they haven't been able to keep up with the pace of everything else that's running off, because you have all these other nations, Japan, China, Germany, whoever, selling U.S. debt, selling the treasuries that they have, and so they're not able to keep up. The one thing that's not, the one thing that's not been on the news really much is that the 30-year yield hit an all-time high, at an 18-year high yesterday or the day before. So when you look at the long end of the curve on those longer terms, that's also part of the problem. So how do they fix it? I don't know. I mean, I read a great summary from a friend of mine that started writing up some stuff yesterday about it's an entire economic, it's a global economic change, and how the U.S. really needs to look overall, that you can't just use CPI and PPI and unemployment anymore. You have to really factor in what's going on globally with Europe and China and everybody else. So, it could be some sort of reset that we're witnessing right now. And I say reset in a way that the global economy is looked at, and how the US looks at rates and that kind of thing.
Okay. So is it still at play? In the past, whenever there's uncertain times, there's a flight to safety, right? So are we still not the safe place to put the money? That's what's going on.
That's what's happening. Yeah, you're not seeing other nations really invest money into our market, and you're seeing the dollar gained a little bit of strength. It's at 100. It's at 100.8 right now. So it's off its lows of $97 at the end of April. Usually that dollar is kind of sitting 101, 102. So we're just not seeing a lot of inflows to that side of it. We're not the safe haven that we always have been currently at the moment.
Well, I mean, maybe this takes time, right? I mean, it's something that it's pretty easy to destroy credibility, and it takes time to gain credibility and trust back. So that at a high level, right? Like, we might just see a gradual movement back to our previous stance, or hopefully somewhere close to our previous stance.
Yeah. Yeah. I mean, the good news is the spreads between the 10-year and the 30-year have remained fairly consistent. We haven't seen that widening where it gets back to 3 points or higher. Because back in 23, when we saw the 10-year get to 5%, mortgage rates were at 8%, a little bit over 8.2, 8.03, 8.02, 8.03, that kind of thing. So, we're still seeing at least some, we're not seeing the spreads continue to get worse, which is that's a positive.
Right. So rates are not getting worse. We just really need to see them. We need to see them get better. And I know that another piece to that is obviously what the Fed's going to do. Before we dig in,
just to clarify one thing, like, they have been getting worse. They're just not getting worse, if that makes sense.
Well, I mean, I don't know. I mean, yeah, I guess they're getting somewhat worse. They're in the high six. It's fair to say that the rates are in the high sixes, and that's where they're kind of stuck, right?
Yes. We have not broken. Like, we actually peaked yesterday at 699, and we had a couple at the end of April days of 698, 698, 694. So we're still in that top range of where we have been for some time. We haven't broken 7 and sustained over that. So that's positive.
Got it. So Aaron, again, we'll dig into the numbers. We'll go deep. We'll get lost in them soon. What's your overall? I want Aaron's vibe check. Like, how do you feel about you specifically look at the local Austin market a lot? Like, how do you feel about the local Austin market?
Yeah. Right now there are several indicators that haven't been where they are since 2011.
Okay.
It's been such a period of like historic events, even, for Austin, that I went past the typical stretch of time and looked back 25 years. And right now, months of inventory is what it was at in May 2011. There are several other indicators that point to that as well. And there aren't signs that there's nothing pointing to things are improving. So in general, the Austin market it's still it's shitty.
Yes.
The way I see it, like the last time you'll hear people, it's fun to throw around 2008 when you say shitty times. This is not analogous to that, as what Austin's doing is correcting from a bubble, that the meteoric rise that happened in largely 2021 and 2022, we are correcting from that. And so
what's interesting is I generally think that term is sensational, right? But I don't I don't think so. I mean, if you look at what happened and you look at the forces behind it, bubbles are caused by irrational exuberance, and we had all the ingredients to create irrational exuberance. I think that's the best way to define it. So sorry to interject, but I agree with you 1,000,000% that we've corrected from a bubble.
I mean, yeah, I've got some charts that can be a little heady, but absolutely show that like it was a bubble and it burst. We're still deflating a bit. And my best guess is that, markets aren't efficient, that there is like emotion and that it's not like we're going to correct back to, oh, this is what it should be.
Right.
There's going to be a bit of an overcorrection and then we're going to move back to a healthy market. Now, when have we overcorrect? When are we going to be at the point of overcorrecting? Give me a crystal ball.
Right. Well, and I'll be honest, like, I don't know how much price movement we have to make. I mean, we'll talk about this more in a bit, but there are certainly downward forces on pricing this year. But when you look at the charts that I looked at for a minute, it looks like the majority of the corrections already happened, that it happened very quickly. Wouldn't you agree with that?
There was you can see the bubble burst. Home values are still depreciating. And so, we got into it before the conversation as I was looking at the rate of change. And yes, like the rate of change has stabilized, but home prices are still depreciating. And I don't really think we can say that stabilized until we're not still seeing depreciation.
Yeah. Well, okay. So that's depressing.
I can't wait to deliver good news.
Yeah, it's nobody likes to be wrong, and I've been preaching that pricing is stable for 18 months, 24 months now, and it has looked relatively stable. It looks like there has been air has been let out of the demand balloon this year. It's not been a bursted balloon by any means, but we have lower demand this year than we had last year, and then quite obviously we have more supply hitting the market than we did last year. So it doesn't, it takes a freshman in economics to understand that that's going to cause downward pressure on pricing. The good news, I mean, can we start with some good news at least, right? Since we all met a month ago, the stock market has rebounded, and that's something that I'll share a chart right now. Give me a second to pull this up. I'll show consumer sentiment and then the fear and greed index. Consumer sentiment we only have from the month of April, and the month of April, it looks really bad. Here's consumer sentiment. You have, can you see my screen? You have April is the lowest, by far the lowest point in the previous 12 months. It looks like it's about 52 versus the previous year was at 6. And then whenever we met last month, we were in extreme fear in the stock market. And as we talked about last month, this is kind of a good thermometer. It doesn't show you like the overall health, long-term health of the economy, but it's a good thermometer of like how are things doing like right now. And so whereas we were in extreme fear a month ago, we've moved back to greed. And well, gosh, I mean, we're pushing up towards extreme greeds. At least the traders feel bullish in the short term on the stock market, and then that should translate to increased consumer sentiment in the month of May.
Well, but the one thing to think about that though is when you start getting into those extreme greed, like you get overbought, oversold, extreme greed, extreme fear. When you look at that, you're not going to stay in extreme greed very long. It'll start to go the other way. So we'll see, the S&P peaked at about 6150, was an all-time high before we came down, and gosh, I mean, we got as low as 4800 pretty quickly. Now it's almost fully recovered to where it was 5900 today. So what I'm really keeping an eye on is, do we get back there? Do we have a double top and then we have another leg down? There's a lot of things that could happen. So it's all very interesting to me to keep an eye on for sure.
Well, it certainly is. And I mean, I'll say that what continuously surprises me is just how, I mean, Aaron, you mentioned a minute ago that markets don't ever correct back to where they need to be. They always overcorrect. And that's certainly what's happening, right? The market overreacts to the tariffs. It goes back to like extreme fear, almost down to zero. And then, okay, things look good again. And then people go in, they pile on, and it goes to greed, close to extreme greed. I mean, this isn't advice or even interesting other than to say, like, can we just be neutral for a while, right? Like, I just want an even keel. I feel like we've been on a whipsaw since 2020. And I think everybody would like to see just a bit of stability. The other good news, and Aaron, I do want to get to the local statistics because I think that's what will be the most interesting whenever we start digging into a lot of numbers. But in terms of
News first.
what's that?
I said, yeah, but we want to talk good news first.
Well, we honestly,
Get Aaron off of here.
no kidding. Really, rhetorically, we want to end with the good news, and I don't think we're probably gonna do that. Max, I want to kind of tee you up for some more of the mortgage market stuff, because the mortgage market is really what drives the real estate market more than anything. It always surprises me just how much it drives it. And so, what we talked about, that the rates are now they're in the high sixes. They have been in the high sixes for the entire, for about the past 30 days or so. If you look since the first of the year, whenever we were above 7 for quite a while. And then now it feels stable to me. It feels stable in the high sixes. And this is the Mortgage Banker Association data that you and I look at weekly. And this has been, I think this is the fourth week in a row where the news is very positive. And it's been double digits for the past 2 weeks, where we see nationally purchase applications are up 18% year over year, and purchase volume is up 21% year over year. From that perspective, it looks like the public is pretty, or consumers are pretty desensitized to these, like, historically, or these higher rates, and that they also feel like high sixes are not that bad. They feel like high sixes are acceptable. So Max, what are you seeing? I mean, I know you're in multi-market, multi-state. What are you seeing in the national news, and then what are you seeing locally? What are you seeing locally in Austin?
Yeah, so like when we look locally, if I'm comparing year over year, just locally, and let me actually change one thing, because here, if we look locally, here, I'll share the screen with you. We're down.
This is your internal data?
And so this is just purchase applications. The blue line is this year. The blue bars are this year. The black is last year. This is just new credit pulls, new loan applications. So as we come to last week, so we were up last week. From the last couple of weeks there, we were up about 5 weeks back. But when you compare it to where we were last year, and this data set is just Lehman Team, which is my most reliable.
Well, yeah, because it normalizes for your growth, right? Like if you were looking at
right.
People, it's
and I can add the other Boston branches, but it doesn't really change much. It also, what's interesting is, obviously I talk to a lot of other loan officers at other companies here locally, and I mean, some people are different, but for the most part, we're all kind of feeling the same thing. Applications are, you've got a great week, and then you have a couple of bad weeks, and then it's like, okay, it starts to get good, and then it comes down again. So it's not fully lining up with what the MBA is seeing. But then again, when you look, like, my whole Facebook feed is filled with nothing but real estate agents and mortgage lenders talking about everything all the time. But the one thing that you typically see is everybody talks specifically about Nashville and Austin, and our markets being kind of reverse of what the rest of the nation is seeing. Most
Nashville's performing poorly as well.
Yeah. So yes, Nashville also, they really saw kind of a run up the same way we did. And so you see, our problem is too much inventory. And when you talk to loan officers and really in other states, right? Because Dallas kind of has some of the same problems that we do, maybe not to the same extent, but you talk to loan officers in Nevada or Oklahoma or wherever, their problem is still not enough inventory. And that's really the headlines. Like when you watch, Logan Motoshami on CNBC or on his Housing Wire, you talk to any of these guys or you listen to them talk, it's always inventory is still a problem. We're still at all-time lows for inventory, that kind of thing. But our specific market is not. And, we see a lot of contract fallout. a lot of canceled contracts, I got buyers that look at properties for 2 and 3 weeks before even submitting an offer. And there's no sense of urgency because of the amount of inventory. So it's definitely a tale, like you love to say on all of your stuff, real estate is hyper local. And it's true. And I think we're seeing that. And again, like I think even when I talked to an agent this morning, Renee, who had a property listed that was getting no showings, then it had 2 showings, then it had nothing, then it had a great weekend. Now maybe 2 people are going to put in an offer. And so you hear a lot of that, like certain areas, even in Austin, are still really hot and doing really well, and others just sit forever and ever. And obviously, price is a function of that.
Let me speak to the whole dynamic of 2 showings, 0 showings, and then all of a sudden you have an offer. What we have not seen in quite a while are days on market that we have right now. So from memory, I think that the resale 5-county metro is something like 70 days on market before it sells. So it's just a lot lower demand. And whenever you have a higher inventory, higher days on market environment, you have to be a lot more patient. I remember telling sellers in 2011, 2012, yeah, no, as long as we're getting 2 or 3 showings a week, we're doing really well. And yeah, we need to stay at this price for 30 to 45 days before we consider a price reduction. And that's tough. It's tough to acclimate yourself to that environment, especially whenever you've had such a whipsaw where 4 years ago, that sounded insane. There was no way that anybody would need to stay at a certain price for 45 days before they would consider a price reduction. So it might be a strategy and sort of advising change that people need to make, and they need to shift their narrative and help people be a little bit more patient.
I think expectations it's always the key, right? Like you always have to just be setting proper expectations more than anything, and then really listen to what the market's telling you, right? The market's you price it wherever you want. The market's going to end up telling you where it should be priced when it's all said and done.
What are your predictions for mortgage rates in the next 3 months, 6 months, 9 months?
Well, I don't know. I really like it. I don't know. Probably the most likely scenario is we kind of stay in this range bound. Maybe we break 7. Maybe we cap at 7.25. Maybe we stay between 6.75 and 7.25. That probably seems to be the most likely given this environment.
Do you think they're going to go up?
They could. They could. Again, like if you go back to what I showed you today, we are right on the cusp of, if the 10-year breaks through 4.55, it's going up. And then where does it stop? 4.8, 5, 5.2. Like, anything could happen. You see these charts that I show you. The bond market can move a lot in a very short period of time. The same thing can happen on the way down as well. So do we stay range bound? We could stay kind of in that range. Maybe it's more 7 to 6.5. Maybe my theory is still on the table, and we see a 5.99 sometime this summer. It's really, so much has changed, and the way that we've always looked at this is really, it's changing in real time, right? Like reasons that the bond market should be improving, and they're not. You saw CPI came out on Tuesday, the lowest in 4 years. And the bond market got worse. Like it got worse. Like that a move like that last year would have improved pricing 50 basis points.
Right.
We would have seen rates come down 1/8 to 1/4 in a matter of a couple of days. And then you add to that the PPI numbers and the retail sales that came out today, negative month over month. That like if the bond market didn't go down today, I don't know what would make it. So like I was glad to see that. But man, it's hard to know. We're just really kind of stuck in this kind of unknown. So it's really, really hard to even make any sort of rational prediction. I guess if you're going to put me on the spot, I'm going to say set 5.99 to 7.25, and we're going to be somewhere in there. Yeah. It's really hard to know.
Yeah. There's no personal reasoning or any logic behind this whatsoever. I queried ChatGPT to give me a bull bear and base case scenario for rates by quarter through the end of the year. And then I took that and I ran it through Grok and asked it to fact check it and improve upon it. And it came back with the same prediction. And again, I didn't ask it for any of its reasoning. So this is all it says. It says the base case is that by the end of the year, it'll be around 6.3 is what it said. So I don't know. That's probably as good a guess. That's probably as good a guess as anybody. It sounds reasonable.
Max GPT, what can I tell you? So yeah, I mean, I think again, like for any loan officers that are listening, and obviously there's a lot of realtors listening, it comes down to payment, and you still need to focus on payment and not rate. Here's a great example. I actually was talking to a realtor in your office. There was a deal that went south that I stepped in to try to help, and there was some, is it warrantable, is it not? Well, if it is, we can do this. If it's not, we can do this. So is the rate 7% or is the rate 8.6%? Which of course freaks a buyer out. But then when you say, well, hold on, it's 8.6%, but there's no mortgage insurance. So really the payment that you think is going to be $300 difference is really only about $100 to $105 difference. That's not that big of a deal in the grand scheme of things when you're looking at stuff. So it goes back to really taking the conversation away from rate and talking about payment. Obviously, rate's going to be a part of that conversation, but the rates are where they are. Where's the payment? Where do you want to be? What is comfortable? How do we get there? And then you can bring in things like the buy downs that everybody likes to talk about and all of that. But it's really just, if it makes sense at 6,625, it makes sense at 6,875. And so you get back to what payment, what are we looking at, and stop focusing on rate. Focusing on rate is because you don't know what other questions to ask, right? And because Rocket put out an ad that said the rate's 5,875, and then you get the thing and it costs 5 points or 6 points to get that, which is like, you shouldn't do
How
that.
are they advertising that with APR? I mean, that's thought that was illegal to advertise.
No. You can advertise a rate. You just have to then also say it costs this. These are
Oh, but just in the fine print.
like in the fine print. But like when they get estimates, like somebody calls Rocket and they get an estimate, and then they call our guys back and they go, well, you just quoted me 675, and they're saying 5,875. Okay, we'll send it over. Well, you're spending $20,000 on a $400,000 house to get that rate. Like, let's talk about, it's not just rate. Like, I could do better than that, but why would you pay that much money for that when odds of refinancing before your break even period of 7 or 8 years are so high? Like, and that's the education. That's really what people need to be focused on.
Yeah. Let's move on to local stats. We have about 30 minutes left. I think this will take some time, and I'd like to finish with strategy and maybe some good news a bit, so that we don't have people walking off ledges after Aaron talks for a bit.
I swear, I'm generally a rather optimistic person.
Well, I will say this. I mean, so what's interesting is I haven't gone to a Mark Sprague talk in a while, but the guy is only optimistic about Austin, and he's correct because he looks on longer timelines than we do. So he generally, he gives presentations to agents, and
Who is this now? Sorry.
his name's Mark Sprague. He's an economist for Independence Title. He does great presentations on the local market. And what he always talks about is like, things are great. Things are great. Again, I haven't gone to one in a year and a half, 2 years, but again, you listen more and you're like, okay, it's because he's talking about 3, 5 or 10 year timelines. And he's not wrong. I mean, in a long timeline, like Austin is incredibly fortunate where we've got a ton going for us, no state income tax primarily, middle of the country. Easy to set meetings on either coast during most of the workday. Our airport kind of sucks, but they're making it better, and we are getting more direct flights, and it's easy to get to either coast, from those flights. And a really
Unless you're flying American, where they canceled half the direct flights.
Whatever. There's a lot of. It's hot outside. Like the airport sucks. Like right now at this point in time, like yeah, there are plenty of things to dog on our situation. But yes, long period of time, things are great. But the problem with that is that, most agents are looking on a much shorter timeline. Like what can I do in the next 3 months, 6 months, 12 months, usually at the longest. So I don't think that any negative news that we see right now speaks to the long-term viability of Austin. It's interesting, Max, that you talked about, Nashville also, being in somewhat of a uniquely bad spot. I didn't know that. I think that Austin and Nashville are very similar in a lot of ways. I think Austin's economy I'm more bullish on Austin's economy long term than I am even Nashville's. But yeah, you have these cities that are used to booming all the time, and then you get into a recession and we're no longer booming, and it feels like we're near death whenever that happens. But with all that said, so Aaron's going to probably tell us some news that is not super great, but this doesn't speak to our long-term opinion of the Metro in any way, shape, or form. So Aaron, take it away.
I am bullish on Austin long term. There's a lot of major companies here. Tax structure is rather favorable. What's happening is we are correct. We were in a huge bubble because people saw how great Austin was. A ton of people came, and then momentum just took us to this unsustainable point.
I think when I looked at your chart that I was confused by it first because I wasn't paying attention. I think the peak of the appreciation was like 1 month was 31% appreciation or something. Or no, was it higher than that? Was it 35? It was something insane.
Let me just show. Can y'all see? There we go.
Yeah.
Okay, so I did not get a lot of sleep last night as I really spent some time just building some one-off charts to explore. Here we go. This is what the appreciation rate is. This is not median sales price. That's how it was calculated. But this is appreciation rate by month for the last 20. So what that means is that in February of 2022, homes had appreciated compared to what they were selling for the prior year by 33%. That's not sustainable.
No.
That is in no way sustainable. And then, yes, as you know, this is the story of a bubble right here. Things got started taking off. Oh, look, July 2020, the correction dipped to its lowest at November 2023. God help you if you bought in November 2022. That's the story of a whole lot of Californians that are stuck in Austin now. And yes, we are not depreciating by as much now. And, it does appear to be a bit more stable, but home prices are still depreciating. Now, I've got to show median sales price and have that on the screen.
Yeah, no.
Because home values are still going up. Real estate in Austin is still a great long-term investment. And you can see that there is even some positive movement going on now. Some of that is just based on, is cyclical, but there. Yeah. What were you going to say, Eric?
That's all I was going to. So where we are now with the, call it -2% is what it looks like we're kind of flattened to.
Yeah.
You have to put it into perspective, going back to my catchphrase, I guess, which is that real estate's hyper-local and hyper-situational. You have some sub-markets in Austin that are getting crushed. You have downtown condos are getting absolutely crushed.
That's
you have you have resale properties that are competing with builders, in the exurbs that are doing pretty damn poorly. So you have to consider that whenever you look at the overall 2% depreciation. I would say probably most neighborhoods are okay. They're probably relatively flat, and some are going up still. Circle C is still doing great. I think, Aaron, did you mention Millwood the other day? Millwood, there's some of these neighborhoods that are historically strong that, they're not appreciating by a great amount or anything like that, but they're still going up in value just a little bit.
Yeah. So with that, let's talk about some of the different markets. And today I'm not going to be focused as much on different neighborhoods so much as different types of inventory. Austin Metro in general, let's talk about months of inventory for it. Right now we're at 5.86. And I said that that's pretty, right here, 5.86. You can see that months of inventory has been pretty steadily growing since, that was a ridiculous low in January of 2022. That's when everybody realized that, hey, the bubble burst and we're still going through this correction. There is a lot of inventory on the market right now, and it maps back to about what we were seeing at May 2011.
Can you hover over around a 2018 period? I just want to
at its worst, we were at 9.4 in March 2000. Sorry, you said 2018?
No, but we can talk about that story too. 2009. We were flushing out of the system a bunch of no doc 0% down loans that had been foreclosed on at that point in time, and that's what had to flush out of the system back then. And then so we had all of this inventory, and nobody was buying because everybody's frightened to death. Max, how many first-time homebuyer loans did you do in 2010, whenever the first-time homebuyer program? Do you remember that? That's what they did to kickstart the market.
Right. Yeah, they got the $8,000. Honestly, I don't have those stats. But, I don't know. It was a lot. That was every conversation you were having all the time. Get this 8,000. Get this 8,000. That was a big deal. It was quite a bit.
But sorry, and then back to what I was going to ask you. So look at like a 2018 level, something like that. So go over. I mean, that's really low. Like that's 3
That is
months
a
of
buyer's
inventory.
market, 2.9%.
Yeah. And then look at 2015. Those were. I mean, there are some peaks and valleys there, but still in the
A little bit
three.
more neutral. Yeah.
Yeah, 3 to 4 range. Yeah, and so now we're at around 6 is what it looks like.
Creeping up on it pretty damn fast. Yeah.
Yeah.
And the direction here, who knows when this will move in the other direction soon, I hope. But things are trending towards more inventory on the market.
Right.
And as there's more inventory sitting, two things are going to happen. One, there's going to be downward pressure on home sales that you're going to have to come off your price. But also, and this is, forgive the visuals, it was just me trying to get a grip on this historic change. This is all the different types of activity and how it's changing right now based off of a piece of the pie. The other thing is you're seeing withdrawn listings are going up, as are expired listings. There are going to be sellers out there that are going to just decide, no, I'd rather not in this market. And I think we're going to see more and more of that. And that comes back to supply. We are at well past twice what the 10-year average is. And demand is, I'd call it about 10% under what we've seen in a 10-year historic average. And prices are, value, the basic market economic forces are supply and demand. Mm-hmm. Now, this is for Austin Metro, all inventory types. For the agents out there that have a listing and are trying to kind of figure out how to approach it, how to approach listing appointments, how to approach pricing, take a look at some of the submarkets. Because overall, like, we are still not technically in a buyer's market, inching towards it. But if you're selling a condo right now, we are at 10.7 months of inventory. We are an extreme buyer's market.
And that doesn't count all the new developments that are not, I assume that doesn't account for all the new developments that aren't listed on the MLS that are getting ready to start closing or are closing, and others coming to market. So when you look at, like, there's going to be another 1,000 units probably with some of that, I would guess.
I would not be surprised. Yes, that's putting pressure on this inventory because there are a lot of off-market choices as well. Condos is probably the toughest market. Now, the interesting thing is new construction. We're right in a balanced market, 4.5 months. You're looking at the demand has been growing this year. Now, how I'm interpreting that is that there's a lot of inventory. The psyche of someone selling new construction is different than resale. You've got resale is typically somebody's personal home. New construction is typically a business. And they've got to sell. Like, they can't say, oh, we'll just hold on to the home for a couple of years. They've got to move it. They are providing, I'm hearing lots of stories of aggressive incentives. And, buyers right now have their choice of whatever they want. And it seems as if new construction, they are doing everything they can to attract those buyers. And in my experience, buyers like done. And by done, I mean just there's no work to be done with it. And so if you're a home, you better be doing everything to make it perfect before you list it.
We had this same discussion on Tuesday internally. We do a market watch every Tuesday, and Craig McGuire, who's a real heavy lister and he's super high success rate, he was just casually mentioning, he said, we're not doing touch-up paints. We're painting the entire house. And if the roof is trashed, we're proactively putting a roof on, which sounds crazy to me because, it's just sort of common knowledge that you don't usually get the money back on a functional improvement like that. But the buyers don't want to do anything. I mean, why would you? You have everything to choose from. There's no urgency in the market. Most most variables are pushing you towards not purchasing. There are a lot of things that are trying to talk you out of making the purchase. And so if you're going to buy something, it needs to be an amazing price and almost too good to be true. That's what's selling right now. Homes that they need nothing. They're priced incredibly well. Sellers willing to give away their firstborn. That's kind of where we are with it. Have to point out how this is an absolute yin to the 2021 yang, right? I mean, we use that same term. Buyers will give away their firstborn to get a home under contract in 2021. And so this is, Aaron, back to your point about, a correction of the irrational exuberance from the early pandemic. Yeah, I think that explains everything. I think that tells the story very well.
For the last 5 years, it has just been extremes inside of Austin real estate. Hopefully we'll see this correct sometime soon. But here, I don't need to share my screen anymore. But if you're an agent and you feeling whiplash and you're feeling exhausted, it's reasonable that things have changed so dramatically from one direction to another. And now we are in a tough market.
If I can be the pep talk, right? So we're doing a lot of comparing today to 2022 and 2021. And the silver lining here is that mentally agents are not comparing today to the heady times, right? We're comparing today to last year. We're comparing today to 2020 when things were not super amazing. And right now, whenever you just do year-over-year comparisons, I'm going from memory, so I could be off a bit, but I believe year-to-date volume is down 10%, right? Not great. Double-digit decline in volume is not great, but it's not, we're not down 40%, which is what it would look like if you compared it to 2022. So the agents that are still here, the agents that are still working very hard, you don't have to dial up your efforts this year that much versus 2024 in order to maintain your success. And you could almost argue that you don't have to dial them up at all. I wouldn't be good advice to not dial them up a little bit, but whenever you account for agents that are dropping out of the business, even though the volume has gone down, when you have fewer agents that are servicing that 10% decline in volume, your efforts this year are probably yielding similar results to last year, with the exception of the fact that days on market have gone up. So the cycle to sell a home is a bit longer. The cycle for buyers to buy a home is also a bit longer. So the charts are depressing. Don't get me wrong. Great job. But I do think that in terms of business strategy, it's not as dire as it looks. I would also say that another silver lining is that we don't have to spend as much time educating buyers or sellers now. I'll tell a story, and maybe it's relevant, maybe it's not. But whenever the mortgage market shifted suddenly from 2007 to 2008, 2007, you could grab anyone off the street and there was an 80% chance you could qualify them for a home. Oh, your credit's decent, above a 650. Yeah, don't worry about it. You don't have to prove your income. You don't have to do anything. We can go buy a home, right? And then that shifted a very good correction in my opinion, in less than probably 6 to 9 months. And all of a sudden you had to prove income. You had to be creditworthy. And I remember I had to educate people a lot. You would talk to buyers and say, no, I'm sorry. It is going to be somewhat painful. Yes, you do have to have good credit. And that was really painful to do in 2008, especially whenever you didn't have a lot of interested buyers out there. So in 2022, when the market shifted dramatically, and in the fall of 2022, it was very, very clearly we're no longer, the market is deflating, bursting, whatever you want to call it. You had to spend a lot of time educating sellers. 2023, you had to spend a lot of time educating sellers. 2024, a lot less time. And this year, I don't think anybody's spending much time at all convincing anybody that we're in a shitty market. I think that's sort of a given, right?
So to be clear on your silver lining, the market has been bad enough, long enough that at least people are expecting it.
It's easy, man. It's great. And here, I'll tell you and so Max doesn't have to spend much time telling people that rate's going to be 7%, right? Is anybody surprised?
I mean, people know, here it is.
Yeah. So yes, Aaron, I know that sounds weird, but Yes, it makes our job easier that we don't have to tell people, when you deliver the bad news, it's already, it's
Well, when rates went from 3 to 8%, that was a very, very difficult thick pill to swallow because most of these people, even when rates got to 6 and 7, in that they're like, oh no, rates are 3. I mean, I still have a sticky note on my desk that says it's got the customer's name and refi 3.375 at no points because rates had got to 4.125 or whatever. And he was like, no. I was like, I think this is probably it, and didn't do it. And so I kind of keep it up there. But when you're explaining to people that rates just went up 3 or 4 points, it takes a long time for that norm to set in. So we really started seeing more of that acceptance,
yes.
Towards the end of 23 and really into 24. And then what became difficult was when the Fed started cutting rates in September and rates started getting worse, right? So all the news is saying rates are going down, the Fed's cutting, but now we're having to explain on our end that mortgage rates are actually going the wrong way and getting worse because of it. Those are hard pills to swallow in times right now where it's all that anybody's talking about and rates are getting worse and this is the rate and like acceptance is much easier to deal with, even if you don't like the answer.
So Max, I think this is pervasive across markets. In 2024, how many rate cuts were priced in to the market last year? Something like 6.
6.
Yeah, we have. I'm looking at it right now.
3.
Yeah, what's that?
We ended up with 3.
Right. So this year, if I go to the CME FedWatch tool and go to December, we've got about 1.5 rate cuts priced in right now. The market does, right? So everybody has sort of come to terms with like this is kind of depressing. It's not great. Expectations are much lower. So since expectations are much lower, we don't have to spend as much time educating. We don't have to spend as much time doing that. You do have to spend a lot of time servicing. We're spending a lot of time talking about how do you systematically update your sellers. One strategy that we talked about on Monday, and you take these to an extreme because it sounds funny and it's more fun to talk about. And we said, look, I want my sellers to reject my call, right? I want to call them enough that they're like, oh, it's Eric again, hang up. And obviously you're not pestering them, but if you call them every Monday and you send them market reports every Monday, you're expressing care, you're expressing attention. And these are the efforts that we're making in order to retain these clients. These listings will sell. The majority of them will sell this year. Now, majority is 51% or more, by the way. So the majority of them will sell. I don't know if that'll be 51 or 70% or 80%. I hope it's 80. But those that don't sell this year, they will sell next year or the following year. And if this is a great client who's reasonable, I want to be their agent this year, next year, or the following year. I really don't care. I'm going to sell it at some point. So that becomes the business strategy, and the name of the game is amazing service so that you don't lose the client. Because what's the alternative? You're going to go out and beat the bushes and try to find a seller who's willing to fire sell and sell it in a week? That's not going to happen.
No, I agree. I was just looking at something. I'm going to share this real quick because we were talking about rates and how fast they can move. So if you look here at Mortgage News Daily, last year was a great example. This is right when the Fed started cutting rates. Mortgage rates were at 6.11 on September 17th.
Good time.
November 6th, they were 7.13. So we saw rates move a point in under 60 days. And and then if you look here, you're 803 October 19th, and then December 14th, you're 662. Like, this is how fast things can happen. So to still have my theory on the table, 45 days, 60 days, there's still time for that. When these things move, they tend to move very, very quickly.
Here's what I would say to that is that'd be amazing if you're right, and I hope you are. I hope it's 599 by the end of June. I don't think we need that. How likely do you think it is that we're like 7.25 by the end of June? As likely?
At this moment in time, I would say maybe it's more likely. It's very hard to say. All the metrics.
Okay, but how likely it is that rates are about the same?
I think that, yeah, I'd say it's probably the most likely scenario is rates are about where they are.
So from a business strategy perspective, if you want to like teach a class on it, you're going to have your bull case, your bear case, and your base case. And you need to have contingencies Well, you don't need a contingency for the bull case. That's just like go work and make money, right? You need to have a contingency for the bear case. So if rates are 7.25, are you out of business? The answer needs to be no. The answer needs to be you are in business even if rates.
Well, just so you know, the answer is no. I'm still in business.
Right. But I'm not saying you, anybody, a reasonable bad case scenario. We're not planning for nuclear war. We're planning for 7.25, 7.5. Like there's a contingency for that. I have reserves for that. Right. Bull case, easy. I'm just going to make more money. But you really need a business plan for base case. And I think base case is high sixes in 2 months. I think base case is maybe it moves down a little bit in 3 to 4 months. And in those scenarios, I don't know that things get much worse than they are right now. I don't know that, Aaron, we're talking about, very, very small depreciation here. And yeah, that's not awesome. We want to see it turn the other way. We're watching inventory climb a little bit. And yeah, that's not awesome. We want to see it the other way. That makes servicing your clients tougher whenever you're in like harder market conditions. But I don't know that the overall volume year over year changes much, really.
The only thing that I think is that when you start to see rates and the media is saying rates have a 5 in front of them, and that's what the headline is, I do think that moves the needle. I think that buyers that are sitting on the fence, people that are really focused on rate, because that's what they focus on, when the 6 handle is gone, I think that does have some meaningful movement.
No,
And if you're talking about,
I'm not arguing with you. I think that's I think it's a bull case. I think that with a 5 handle, given that we've been in a really fluctuating rate environment and it's been high, it's been almost 8. Rates back in the 5s all of a sudden, 5.99. That sounds really good. Like if I've lived in my house since 2022 and I've pushed off a move, the picture I always paint is you have a younger couple that maybe they had one newborn in 2022 and they didn't buy because of rates, and now like that kid's bigger and they've got another one on the way or another one's here and they really want to move. It doesn't take rates even in the 5s. It just takes like things look really stable and not scary to cause that couple to move. And then you have others that maybe don't have as much external pressure, but they still have external pressure. It's good for them, for their life to move. Yeah, if rates get into the 5s, like we're back in business. Like that's something that I think is going to feel really, really good because it's all about perspective and expectations. And 100%. If you expect things to say shitty and then all of a sudden they are not that crappy, I think that things all of a sudden improve pretty quickly. But at that point, again, business planning is easy. Whenever things are improving and it's like we have traction and everything's going in the right direction, it's not super hard to business plan. And what's tough to plan for is that contingency of maybe things get a little bit worse. What do I do in that terrible scenario? And then how do I plan for like this just persistently sort of crappy summer that we may have, Yeah. I mean, I think about it. I liken it to whenever you're staring down a summer and it's like, wow, it looks like we're going to have over 100-degree heat for 3 months again.
Or next week.
I'm not a superstitious guy, but like everybody keeps comparing this to 2011, and that was like a terrible heat wave, plus like probably one of the worst years of the recession, and then it finally turned after that. Like we finally had like a really good year, and the summer wasn't too bad the following year. So hopefully, hopefully that pattern is consistent.
Yeah.
Yeah.
I mean, even the stats are in line with 2011.
That's what I mean.
Shut up, Aaron. No one's talking to you.
Aaron, what do you see positive here? Like I'll throw you a bone. Maybe you don't have anything because you stayed up so late and just digging into all this negativity.
What I see positive, and this is something that I'm curious to explore, is really something that you pointed out, is there's, for agents, there's absolutely attrition going on where it was easy several years back and there were tons of agents in Austin that were producing. Just because things are slowing down does not mean that agents' businesses are going to be necessarily substantially suffering at the same rate of the market, because this is the time where the part-timers get out of the business. This is the time where not everyone's jumping to get their real estate license and get into it. The positive thing is that ignoring what's going on with the stats, this is the time the agents that run their business like a business are probably going to be just fine.
Agreed.
Well done.
Max, any final thoughts from you?
I mean, it's keep grinding, keep hustling, keep outworking the competition. Do do the things that work, focus on the things that work, and stop focusing on rate.
Yeah, no, focus on the effective 100%. And all I'll add to all of this is that acknowledge that you can't control the market. You can't control the environment in which you're working. You can only control how you react to it and what you do to succeed in that market.
You can control your attitude. You can control your actions. Positive attitude, positive actions will equal transactions.
Agreed. Thank you guys. And thanks everybody who hung on and watched the whole thing. We appreciate you guys.